Hello everybody, welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today's video is part of a multi-video series that we're doing. If you didn't watch yesterday's video, I'm going to drop it right up here so that you can click on it, put it to the side, and then watch it later where we talk about what home prices are likely to do the next couple years. Now, what we're going to do is talk about the interest rates, where they're likely going, where NAR thinks they're going, National Association of Realtors, and we're going to talk about the impact that's going to have the housing market given all these other things. Now, remember, we've got like 80 slides, but we can't go through 80 slides in one video, so we're breaking them into smaller videos, and that's sort of today's thing that we're going to do.
So we're going to talk a little bit about rents and about mortgages and inflation and all that sort of thing. So hang tight with us. We hope that you get some good information and this is interesting for you. If you're interested in buying or selling in Las Vegas or elsewhere, please remember that our contact information is below and you can reach out to us and we would be happy to help you.
Okay, so we're going to start with the premise that interest rates are high because we had inflation and there was too much money chasing not enough goods and services. So the Fed raised the federal funds rate in order to dampen borrowing so that the spending would be more in line with the number of goods and services. And when that happens, when you have too much money chasing goods and services, causes the goods and services to go up in price because the suppliers see they have a demand for their product. So what do they do naturally? They don't run out of the product. They raise the price on the product. They're just trying to match the, it's just a shift in the demand curve.
Right.
Okay? Because supply curve doesn't change. You just have a shift in the demand curve.
Correct.
So we're going to show this first chart here. Now, what this chart is, now the red line is sort of the key. That's the core CPI. The blue part of the CPI includes energy and food, which are pretty volatile. And the core is predominant, like 50% of that is rents. It's highly driven by rents, okay? And if you look at the chart, you can see that we have this 2% or just below 2% inflation rate. And then you have the aftermath of the COVID spending. Now, remember, the COVID spending actually took place in the summer of 2020.
Well, it continued on. But
it continued on, but that was the initial shock. But you notice this, that we didn't start to see that increase in inflation till like the middle of 2021. It took almost a year. There was this lag effect. And then remember that we didn't see the interest rates starting to go up until like January. So the Fed said, hey, it's transitory. We don't think it's going to be that bad. It's going to go away. It was just, and they saw that as you can see on the chart there, in September, it looked like it was starting to drop again. Then it took off again. And they're like, holy cow, this is inflation. And they had to take action. Okay. Now, so what went in was about 7 or 8 rate increases. And we went from 0 to like 5.25% or something, current rate. And that happened really over only about 9 months. They ratcheted interest rates for 9 months. And we've been sitting now on the borrowing rates for quite a while. And you can see that it has taken time. But if you look at the red line, you can see where this is heading. Now, remember, we talked about this before, Wanda. There's this lag effect, right?
There is. So that's for a lot of reasons. Like Todd said, it has to do with supply and demand. And it has to do with rents, right? Rents are harder for this to show up on this line because remember, most people have have year-long leases, so they don't get those rent increases every day, right? They get their rent increases once a year, and they also don't do these surveys at that frequently. And remember, a lot of this data is basically survey. So it's a lot of those combinations, which, for those of you that are sitting there scratching your head going, okay, this is 2024. If I can have instant information about everything else, why can't the government get instant information regarding our economy? Take it up with your government, not with us. This is what we have to work with. The truth of it is that because all economic information and all economic policy has been based on this over time, this is not necessarily a bad way to make decisions because this is how we're accustomed to making decisions. I think that if we made decisions about the economy in real time, we would see a lot more volatility. So there is something to be said about doing things with a long lag time.
Now, Juana, you mentioned that they don't poll every day. They poll actually, it's like every quarter, 6 months, they come up with new data, and then they sit on it, and you assume that that's what rents are doing. So here's a chart. Now, this chart time frame is a very small time frame. It actually goes from 2022. Now you can see that the blue line is official government data. That's what they're including in the CPI, and then this red is the unofficial private sector data. They don't use that, but you can see that according to unofficial private sector data, which probably leads. And the way to look at this is you see where all the way to the left, that red line is up high. That's probably the government data just took a while to catch that. So you see that the government data starting to decline. You could see that it's going to follow that red line down to basically a smaller number for rent increases. Now 5.3, there's this other theory here. Let's talk about this one. That the high rents are causing the inflation. So that's restricting borrowers. It's locking people in from selling, which is causing a limited supply, which is making more people have to rent since they can't buy. So it's literally like this self-fulfilling loop that they've gotten themselves into. Rents are always going to be high while they have interest rates up. They need to get interest rates down because remember, home prices are not included in the CPI. Only rents. Why aren't home prices? If home prices go up 10%, why don't they say inflation's 10%?
Because homes are considered an investment, they're considered an equity, while rents are considered a consumer good, much the way a car is, or a washer or dryer or some other item that you purchase for a one-time use.
Yeah, bananas, anything.
Right. So that's part of it. The other part is, not to get political, but it doesn't matter what happens in November. I think there's this sense that there's turning over a new page and the economy will do something different. And I think that's part of all of that plays into this. And we do see that with every election, no matter what political party or person is in office, whatever. It's not really as relevant as we see this whole optimism thing that kind of starts to get spooled up. And we see it in November, regardless of who wins. It doesn't matter.
Yeah.
I know parties would like to let you know that it matters, but it doesn't. So we do see that. And then that plays into people's psyche, and it plays into into pricing, it plays into inflation, that sort of thing. And so there's this whole honeymoon period, right, that we all hear about for the first 6-8 months into the new year, and things kind of chill out. Interest rates will probably be reduced during that time. How many times, I can't say, but they will go down regardless of what happens with the election because of that whole honeymoon thing. And then we'll see what the economy does, and then the Fed will revisit it more in earnest and make choices going forward.
Okay. One of the important things to understand about this chart is that it is not likely long-term that rents will go to 0 or 1% and just stay there. Rents, historically, even when we had 2% inflation, you saw the inflation chart. Mm-hmm. Remember, home prices appreciate at 4.6%. Mm-hmm. Rents will beat inflation by 3%. So you could infer that if we have 5.3% inflation, we probably have 2.3 to 3.3% inflation if rents are going at 5.3%.
Right.
Because rents tend to beat that. Okay.
Right. So this is really important because keep in mind, okay, let's look at wages against that. So when you're looking at wages against that, so your wages hopefully keep up at least with inflation, but they're not going to beat inflation by a whole lot usually, but your rent will outpace inflation. So this is the reason why a lot of people say, hey, you're better off buying than renting, because over time, your mortgage payment will actually be less than your rent payment would be, even though it may be higher on the front end. And as inflation keeps doing its thing, rents would have gone up while your mortgage payment remained consistent, and then that allows you to get ahead. That's the whole point of buy versus rent. Generally, buying is more expensive on the front end, but it saves you money on the back end.
Okay. With that in mind, I'm going to put up this next chart. Now, this is the percent of income required for a mortgage payment. Now, this takes into account increase in wages, increase in home prices, and the increase in interest rates. Now, what is likely to change the fastest one over the next 2 years? Home prices is a percentage of what they are today. The incomes is a percentage of what they are today, or interest rates.
What's most likely to change?
Mortgage rates.
What's
Yeah.
most likely to change?
Yes.
Two things: prices and interest rates.
Okay.
So incomes will have the least change, and the most change you're going to see, probably the most dramatic change you'll probably see in interest rates, followed by home prices. And the thing you have to keep in mind about home prices is that even though interest rates will go down, prices will go up, so that mortgage payment is not going to be substantially different than it would be today, because your interest rate is higher today, maybe the price for the home is lower today. Tomorrow, when you have lower interest rates, more people trying to get the market, more competition for those same homes, you're likely to see a higher price for that home, so your payment may be about the same. The difference is that when you're buying today, you can refinance down the road and lower that payment, versus buying down the road with the lower rate, higher price. You can't change your price that you pay for your house, but you can change your interest rates through refinancing. Clearly, this is a case-by-case basis, and I'm not giving you financial advice. We're just looking at general trend lines and what we've seen in the past.
Okay. I'm going to give an analogy for Juana said. It's going to be an extreme analogy, but I just want to point out there's some people who would take the deal. Okay, so imagine this. Somebody comes to you and says, I will give you $100 a day for the rest of your life. Now, it's $100. So if that means, yes, in 20 years, it'll be worth less because it's just going to be $100, right? Or I'll give you $50 a day for the first 5 years, but then I'll give you, after 5 years, $1,000 a day. Now, Juana is a Romanian, okay, who understands money. Which of those two deals would you take?
I would take the second deal.
Okay, the second deal. Here's the problem. You have some people who are going to say, well, yeah, I got to have I need the extra $50, so I can't take that deal. Like, I got it. The $50 a day is a deal breaker. I know I'm going to get less in the end, whatever, right? And then they'll take the $50 less, or $50 more now. They won't deal with the less. Or they'll say, you know what? I'll bet this is a trick. I'll just take the $100 while I can, because I know they're never really going to give me that 1,000, right? So they either, and the reason I'm saying this is because I hear that's what people say when they talk about buying a house is, oh, it's more right now, and yeah, I get it. You know, that in 10 years I'll be way better off. I'll have equity, and all my payment will be less than like my rent will be. But they don't want to look in the future. They don't believe it or whatever. At the same time, they complain that they missed out on buying a house 10 or 15 years ago. And I'll give you an example about that here on this chart, this percent of income for mortgage payment. Historically, the percentage income to the most mortgage payments has been about 15 to 20%. And if you look at now remember, interest rates have moved around quite a bit during the life of this chart. And if you basically go from 2000, the left side of the chart, to 2021, they didn't really change that much. You have the bump in 05 and 6 where home prices were up a little bit. Home prices did decline, but a lot of that was because interest rates were low. A lot of that where you see it around 50%. Now remember, from 2010 until 2021, that was the lowest period in the history of the country where we had that many years where interest rates, you could buy a house literally 3 or 4% interest rate. You almost couldn't do it. So you can see the run up when you look all the way to the right of the chart. That is predominantly interest rates. This is mostly interest rates. Like Wanda said, if home prices go up 10% in a year, but interest rates go from 7 to 5, that's like a 30 or 40% reduction in interest rates. Mm-hmm. So you'll see this percentage of income dive. And I think the question that I ask people is, if you knew for sure that the house you were going to buy today, it's $500 more a month, but in 5 years it would be $100,000 more than it's worth now. And even if you didn't refi it, your mortgage payment would be less than you would pay in rent. There are people who say, you know what, I still just going to rent because today I need that extra $300, $400, $500 a month. I can't live without it. I got to have that extra money, so I can't buy the house. And then in 5 years, they would complain when their sibling or friend goes, oh, our house is worth $100,000. They go, well, you were lucky. We just didn't have the opportunity or whatever to buy a house, right?
And, we understand that not everybody has the additional funds to purchase. And we're not suggesting that these people are in any way bad people. But what we're saying is that there is something to be said for delayed gratification, for belt tightening, for making some sacrifices today for tomorrow. This is something that everybody has to weigh for themselves and see what works for them at this point in their life. We're just giving these examples to illustrate a point.
And I don't want this to turn into well, you're just trying to tell people that this is the time to buy.
No.
We've never said that. We actually, 98% of all the transactions we've ever done, we're helping the seller sell the house. That's literally what we do for a living, is we help the seller sell the house. But we want to point out the relationship between interest rates, prices, and long-term opportunity, and this myth that you have to wait until it's cheaper to buy before it's a good time to buy, because that may never happen again.
Right. So the right time to buy is not market specific, interest rate specific, or house price specific. It is your particular circumstance. And that's why we say we don't tell people it's the right time to buy, because we don't know your particular circumstance. And we can't ever know that because we're not living your life. So that is something you have to decide.
Okay. The last slide for the chief economist at NAR went over, and we're going to talk about this. Okay, so the upcoming rent growth should be calmer. Mm-hmm. So rent growth should chill out, which means inflation will go down, which means the Fed will be able to cut rates, which is great for the housing market, right?
But this is only in the short term, okay?
Yeah, we're talking a couple years.
Okay, so, and there are reasons for that. Go ahead.
The future CPI could be calmer. Mm-hmm. The Fed is likely to, over the next, and this is his estimate, by the end of 2025, 6 to 8 rounds of rate cuts in an effort. They call it a soft landing, but they're trying to guess at that lead time that they need. They don't wait till the economy's showing bad data. That's like waiting till the patient is dead and then saying, okay, call supply and have them bring the paddles. Like, tell them to send a truck over to the building and get the paddles and drive him over here. He's dead. You don't wait till the patient dies. When you think they're going to die, you call over and you get the paddles there. So when you think when the heart stops, they shock him, right? Mm-hmm. That's what they're trying to do with the Fed is trying to do. But there was a big but in this, and this I thought was very interesting. A further pivot could be limited by budget deficit. So there's this huge deficit right now between spending and revenues brought in, meaning taxes we all pay. And we've never taxed ourselves out of a deficit. It's always had to been cut spending. And where the government's spending a lot of money. And because of that, it makes borrowing expensive. Mm-hmm. So we may run into a situation where the Fed really can't drop rates that much because we have this, they can't really spur on more economic growth because the government's spending too much money. So they're sucking up basically that money out of the economy. What would happen if that was the case is future rent over the next couple of years would actually accelerate again. We would be stuck in this, we called it Schrodinger's housing market, where we have a low supply, relatively high interest rates, but prices keep going up. Mm-hmm. And then people aren't selling and rents would start going up again because you have more people being forced into rental market, but we don't have enough rentals for everybody. So the winners would be homeowners and then other people. So this is what we're going to do, Juana. We are going to do a forecast prediction.
Okay.
Now, normally we have the crystal ball.
Okay.
Unfortunately, when we attempted to use the crystal ball today, it was broken. We had to send it to the shop. So the crystal ball's in the shop. But instead, we have today the old-fashioned of forecasting. This is a special blend of bourbon that makes it easier to predict what will happen with interest rates. Mm-hmm. Bottoms up.
Bottoms up. Okay.
Take a little sip.
So I think interest rates are going to go the way of these ice cubes.
They're going to go away. They're going to go down.
The way these ice cubes are melting, interest rates will melt too. Just not all the way these ice cubes will melt.
Okay, so here is sort of my prediction. Okay. I am a fan of.
That's really good.
Yeah, that is really good. Oh shoot. Okay, guys, you can buy this at Costco. We get this at Costco?
I don't remember where I got it.
Yeah, we got this at Costco.
Okay.
You can get this at Costco. It was the This is old-fashioned pre-made in a bottle. Just pour it on over ice.
Yeah.
It's amazing.
Yeah.
No, it was the other one we bought.
And
at
no,
Total
this
Wine.
is not sponsored.
We're not sponsored.
We just happen to have tried it.
Yeah, this is. We just tried it. It was pretty good. Okay. I believe in the. I just look at the data, and what the data says to me is we thought rates would start falling sooner. They haven't. I think one of the things we didn't think about was that rents would stay high as long as they did. We thought they would get choked off pretty fast. I think it was a little unpredictable. And if you don't believe me, watch any Crash Bro video from 2019 to 2022, 3-year period. Go back in time, go on their page and go look at an old video. Literally every video for 3 years, the housing crash is like tomorrow it's going to happen.
Or it's
like,
in real time.
We're watching it in real time. This is it. This is it. By 6 months from now, home price will be 30% less, yada, yada, yada. And I think that a lot of people were sort of thrown by this. I think, we're pretty conservative when it comes to making forecasts. But I feel like, except for government spending, which has been a lot, okay, all of the normal signs that the Fed will cut rates and the cost of borrowing will decline. I don't think it's unreasonable by the end of 2025 to see low 5%, which historically would be well below. But here's what I think. Problem is we're about 7 million homes short in the US. We have these growing demographics, Gen Z and millennials, who are, when I say growing, they're growing in their wealth and their income. And they want to buy houses. They don't want to be renters. So I think that huge demographic, and they're growing their wealth and all of that and family, creating a family faster than boomers and the silent generation are dying. So population is increasing. We have net immigration. So I think interest rates are low 5s by the end of 2025. Home prices continue to rise despite, it's low. We have ready for this. We have half the number of houses on the market today we had in 1995. And guess what? In 1995, we had 70 million less people in the US. There were much fewer houses. So we definitely have a massive, massive shortage, which is the only thing driving home prices, not interest rates.
Right.
What's your forecast for by the end of 2025? And if you need another sip from the fountain of forecasting.
So by the end of 2025, I think we'll have more transactions than we've had this year.
Okay.
So I think I see more transactions in 2025 than 2024 for a lot of reasons. And watch the video from yesterday to see some of those reasons. I won't bore you with them today. I think that interest rates will be lower by the end of 2025 than they are currently, which, it doesn't take a genius to figure either one of those out. That doesn't make me a forecasting guru. It's just numbers. It's pretty straightforward. And, realistically, this is just part of an economic cycle. We show you guys these charts, and if you look at them, these are just trends over time, and for the most part, history repeating itself. And that's all that this is. So we're just stewards of information, and we're sharing that with you guys. If you have the same opinion, or if you have a different opinion, we'd love to hear from you in the comments. Okay,
last thing, Juana. We know a ton of people personally that have high 1%, low 2% interest rates. Even if rates go to 5%, is that enough for them to unlock give away the interest rate, liquidate the property, which extinguishes that loan, to go buy something else? Or does that cause all of this regret or other stuff, shock of, oh my gosh, I can't believe, just because I wanted to buy a bigger house, now I have to pay 5% when I was paying 2.25%.
Right. So most of them are going to hang on to those loans, right? Because they're below inflation, so it makes absolutely zero financial sense to get rid of them. However, people do have life events. So if life events dictate otherwise, some of these people may choose to liquidate. Some may choose to just pull out some equity. So that means that those homes would not come on the market. They would just pull out some of that equity because as interest rates go down, those home equity loans become a little more palatable, so they can maybe pay off that home equity loan over a reasonable amount of time, and they can maintain their low interest rate on the on the larger balance of the loan. So there are all kinds of vehicles that people can use, but very few people are going to extinguish those 1.9, 2.9% loans. That's just not reasonable without some substantial life event that people feel that is their best option.
You know what's interesting statistic?
What?
In Vegas, over 50% of all homes are owned free and clear. Cash. They just own them. They don't have a loan on them.
But nationally, it's well over 40%. So
yeah, it's 42 or 43%.
Right. So nationally, it's over 40%. Vegas, it's over 50%. So now those people are off the table, right? And then when you consider the institutional investors, take those people off the table, and you take the people who have these low percent interest rates, take those people off the table. So now who are you left with? You're probably left with maybe about 30-35% of people out there who there maybe a good portion of those, their homes still fit them. They still are perfectly happy as can be, and they have no reason to sell. And that just leaves really a very small amount of people that would be ready, willing, and able to sell. Those people do exist. Obviously, we have homes for sale all the time, but it's much smaller numbers considering the overall number of homes we have in the U.S. than what we're accustomed to having. We do see that inventory is growing across the country. This is a normal thing. It's cyclical. It happens every year this time. So this is not an indication of any sort of bubble building or anything like that. Nationally, we're at about 4 months and change of inventory. Anything under 6 months is considered a seller's market. So again, it's not a buyer's market yet. Are we going to get to a buyer's market? Maybe, maybe not. I think we're maybe going to get to an even point if we're lucky sometime in the fall, and then we are off to the races again in the spring. I think the spring is going to be very exciting. I think it's going to be very volatile.
Yep.
You're going to see more transactions than you saw in 2024 for all the reasons we've enumerated and then some. And that's pretty much my forecast with the assistance of my ice cubes.
Okay. If we have under 6% rates by next spring, it's going to be absolutely panic buying. People are going to freak out. And there's not going to be any more inventory. It's just going to be home price craziness, multiple offers. I don't see that going away if interest rates drop substantially. Yeah. Yep,
I agree. So, What do you think? What's your take on the whole thing? And what if you've tried the drink, let us know what you've thought of it. We appreciate your input. Please remember to like the video, subscribe, hit notification bell, share the video. Again, if you're looking to buy or sell in Las Vegas or anywhere else, feel free to reach out. We'd be happy to help you. And we appreciate the comments. If you see us out in the wild, by all means, please stop us and say hello. We have no idea who you are, but you know who we are because you see us all the time. So please stop us and say hello. We appreciate all your positive reinforcement, and we'll see you on the next video. Bye.
Bye.